Okay, so we'll just proceed with discussing a new standard class. For today, we will discuss PAS 28, or the standard for your investments in associates and joint ventures. Okay, so to just give you an idea, class, before we delve into investment in associates and joint ventures. Normally, the primary activities or operations of a business class would either be in sales or in service, selling products or goods, or selling or providing service. If, if you're engaged in sales, you may either be in production, manufacturing, or you could be simply in merchandising. You buy and sell products. If you are not engaged in sales, then perhaps you are engaged in providing service. Okay, and those would be the primary source of income for those kind of business. But please understand that it's possible for a company to have other sources of income. Okay, and one of these would be income from their investments. Okay, and investments can come in any form. Okay, but the simplest perhaps and would sometimes be considered the most common would be if you invest in other entities. So if you're a corporation and you're investing in another corporation, you're basically becoming a part owner of another corporation. So even though your primary purpose is not to be involved in investing, it's possible for you to make investments on top of your primary business activity. And this is what we will be talking about in PAS 28 and other standards class. An entity becomes an investor for another entity. So we are the investor, we transfer funds or resources to another entity in exchange for participation in the profits and loss of the entity, or for in exchange for return on our investment, which could come in the form of interest or dividends. Okay, but as far as accounting is concerned, the accounting for your investments would depend on the extent of your investment. Okay, if you are a majority shareholder, if you exercise control over another entity, then it would be PFRS 3 and PFRS 10 that will apply, because basically you, the investor, becomes the parent and the investee corporation becomes your subsidiary. That is if you exercise control. Okay, and normally that would be the case if you own more than 50% of the shares of another corporation. Okay, but of course, your investments need not be that big. You need not be a majority shareholder of another entity. Your your investment could be very minimal. Let's say, for example, you will only own 5%, 10%, or even 2%, because your interest is only in trading. You are buying shares own you're buying shares representing ownership over another entity for the purpose of earning profit from short term for purposes of earning profit for holding the shares in a short period of time. Okay, and if that's the case, if your interest in the investee, if your investment is very minimal, then it would be PFRS 9 that will apply. Okay, that is of course if fair value is available. Okay, but of course the rules on whether to use fair value and cost model are provided in PFRS 9. Okay, in between minimal investments class and majority ownership would be your investment in associates. Okay, so we will use PFRS 3 and PFRS 10 if you become a majority shareholder, if you exercise control over another entity. If your investment is very minimal, then it would be PFRS 9 that is applicable. In between these two would be your investment in associates. What do we mean? You have a significant investment, but not enough for you to have control over the investee corporation. Okay, it is less than majority, it is less than 50%, but not so little, not so low that it would just be considered minimal. Okay, and that is where your investment in associates come in. If you have an investment in a level that gives you significant influence over the investee, then the investee will be considered as an associate. Okay, so basically there's levels to this. If your investment is very minimal, uh, it will be PFRS 9 that will be applicable. If your if your investment is from 20% to 50% of another corporation, then that corporation will be considered as your associate, and your investment will be referred to as an investment in associate. If your investment is greater than 50%, then the investing corporation will be considered as your subsidiary. Okay. So for PAS 28, we are dealing with investments that give us significant influence over another entity. Now, if you may ask, where did I get the 20%? Where did I get the 50% uh, floor and ceiling for an investment in associate? The 20% class is the threshold established by the standard that would give a presumption that we have a significant influence over another entity. While the 50% class is also the threshold for us to be considered as a majority shareholder, for us to be considered in having control over another entity. Okay, we will encounter these percentages later down the standard class. Okay, but I just want to establish a basic understanding first that what is involved here is us, the entity, making an investment in another entity. Okay. And I do not want you to have the idea after PAS 28 that all investments in another entity will be covered by PAS 28. Again, the possible options are either PFRS 9, PAS 28, or PFRS 3 and 10, depending on the level of our interest in the investee corporation. Okay. So going now to the standard, PAS 28 tells us that the objective of the standard is to prescribe the accounting for investment in associates. So in case that our investment reaches the level wherein we are able to exercise significant influence over the investee, then it will now be PAS 28 that will apply. Okay, and PAS 28 will also set out the requirements for the application of the equity method. Okay, so this is important class because PAS 28 will tell us that investment in associates are to be measured using the equity method. And equity method is being discussed. PAS 28 teaches us on how to apply the equity method for our investment in associates and joint ventures. Okay, and if you'll take a look at the scope class, it's very uh, extensive. The standard will apply to all entities that are investors with joint control or of significant influence over an investee. And in this discussion class, we will not be talking so much about joint control and joint arrangements class because the discussion on joint arrangement will be done in the discussion for PFRS 11. That's a newer standard compared to PAS 28, and PFRS 11 is for joint arrangements. Okay, but I am not saying that the PAS 28 is already superseded by PFRS 11. PFRS 11 and PAS 28 go hand in hand together. So one of the important takeaways for your study of PAS 28 would definitely be to be familiar with the terminologies. Okay, and the first one here is uh, what is an associate? Okay, who will be considered as an associate? An associate is an entity over which the investor has significant influence. Okay, so there are two entities involved here: the investor and the investee. Okay, the investee, the one receiving our investment, will be considered as our associate if we have significant influence over that entity. The standard discusses later on the later part as to when is significant influence achieved. Okay, consolidated financial statements, you should be familiar with this one already. Okay, the equity method. The equity method is a method of accounting whereby the investment is initially recognized at cost and adjusted thereafter for the post-acquisition change in the investor's share of the investee's net assets. Okay, so second takeaway class, let's go back to the first takeaway. First takeaway: when do you have an associate? You have an associate if you have a significant influence over over another entity. Second takeaway: how are investment in associates and uh, joint joint ventures accounted for? They are accounted for using the equity method. Okay, and what happens in the equity method? Under the equity method, the investment in associate and the joint venture are initially recognized at cost. Okay, so initial measurement at cost. Subsequent measurement, you will just have to make adjustments to reflect the share of the investor class in the profit or loss of the investee. So your investment in associate can go up or down depending on the results of the operations of the investee. If the investee, the associate, earns profit for a certain calendar year, for a certain reporting period, then our investment in associate account in our separate financial statement will be increased by the amount of our share from the profit of the investee. So if the adjusted profit of the investee class is 100,000 and we own 20% of the investee, the associate, then our share in the profit of the associate would be 20,000, and this 20,000 will be recognized as an investment income, and it will increase the balance of our investment in associate. Okay, so uh, again, under the equity method, you start at cost and you just adjust it to reflect the share of the investor uh, in the profit or loss of the associate. Okay, I mentioned earlier the balance of the investment in associate can go up or down. It can go up if the investee, the associate, earns profit. Okay. On the other hand, it will go down. The balance of our investment in associate can go down below its cost if the associate or investee reports a loss. If the investee reports a loss, then we will compute also our share in the loss. Then our share in the loss would be deducted from, will be treated as a reduction to the balance of our investment in associate. And that's what will happen under the equity method. The balance will keep on fluctuating, and the fluctuations are irregular because it depends on the results of the operations of the investee corporation. Okay. This will be your first time encountering the term a joint arrangement. It is an arrangement of which two or more parties have joint control. And joint control is the contractually agreed sharing of control of an arrangement which exists only when decisions about the relevant activities require the unanimous consent of the parties sharing control. More on this when we discuss PFRS 11. A joint venture is a joint arrangement whereby the parties that have joint control of the arrangement have rights to the net assets of the arrangement. Okay, so a joint venture is a special kind or a specific kind of a joint arrangement wherein their interest is not really on the ownership rights of the entity, but instead on the net assets of the joint arrangement. Obviously, a joint venturer is a party to a joint venture that has a joint control over the joint venture. Uh, Third important takeaway, class, would be the definition of your significant influence. Significant influence is the power to participate in the financial and operating policy decisions of the investee. Okay, but your your power to participate is not control, is not equivalent to control, because if that is the case, then it will not be considered uh, a mere influence. If you have control, then that is not just mere influence. So to some extent, we can say that significant influence is inferior to control. Okay, and again, it's very important for us to be able to determine whether the involvement that we have is of significant influence or it has actually reached the level of control already. Because depending on the level of influence or control we have, the standard applicable will be different. Okay. And again, I'm telling you that the definition for significant influence is important because the problems will not always tell you that you have significant influence over this entity. Okay. The problem will sometimes ask you to be the one to determine whether you have significant influence, or you have control, or you do not have any influence at all. Okay. More on significant influence class. Uh, if an entity holds directly or indirectly 20% or more of the voting power of the investee, it is presumed that the entity has significant influence. So this is where we got 20%. The standard tells us that if you have 20% or more of the voting power of the investee, then that would give rise to a presumption that you have significant influence. Okay. But this is what I want students to understand completely. The application of PAS 28 is not dependent on the level of ownership interest. Okay. Because some students, what they do is they look for the percentage class. If they see that it's less than 20%, they would say it's not PAS 28 that will be applicable. If they see that it's more than 20%, then they would say that PAS 28 is the applicable standard, but that's wrong. The primary test, the first question that you should ask is there significant influence? If the answer is yes, PAS 28. If the answer is no, then PAS 28 is not applicable. So when then do you go to the 20%? When then do you go to the 20%? Only if the problem is silent. Okay? Only if the problem is silent as to the presence or existence of significant influence. If the problem is silent, then you check now the percentage of ownership, and if it is at least 20%, then apply PAS 28. If it is less than 20%, then do not apply uh, PAS 28. So the scenario I am trying to prepare you, class, is a problem wherein it says you own 22%, but there are information in the problem that would tell you that you do not have any significant influence. If that is the case, disregard the fact that you have 22%, since the problem categorically told you that you do not have any significant influence, then PAS 28 will not be applicable. Okay? You only check the percentage of ownership class if the problem is silent. If the problem is already telling you that you have significant influence, you do not have significant influence, there's no need to argue with the percentage of ownership. Okay, so that's very important. And of course, again, if the problem is silent and your ownership interest is less than 20%, then the assumption there is that you do not have any significant influence. Okay. Now, in PFRS 3 and PFRS 10 class, it would tell us that if you have control, then you will apply PFRS 3 and PFRS 10. Okay. But one of the indicators of control is if you own more than 50%. But again, the same in significant influence, you only check on the 50% ownership interest if the problem is silent. Okay, but if the problem already tells you that you have control, then it should now be you should be applying consolidation. If the problem is telling you you do not have any control even though you own more than 50%, then definitely PFRS 3 and 10 are not applicable. Okay. A substantial or majority ownership by another investor does not necessarily preclude an entity from having significant influence. This is what I am. This is one of the examples I was referring to. You already have majority ownership. You own more than 50%, but it's possible that your influence in the entity has not reached to the level of control. Okay, so it's possible that you have more than 50%, but all you have is significant influence. And in that case, it will PAS 28 that will be applicable. The existence of significant influence by an entity is usually evidenced in one or more of the following ways. And this is what I want you to be familiar with. Because if they are present, then that would be an indicator that there is significant influence. And this could be a good source for a multiple choice question. So make sure to go over these examples provided in the standard. Okay, representation on the board of directors of the investee, participation in policy-making process, which is in line with the definition for significant influence, material transactions between the entity and its investee, interchange of managerial personnel, or provision of essential technical information. So make sure to be familiar with these things. Now, in assessing whether or not the investor has significant influence over the investee, you do not only take into account existing shares. Okay, so when we become owners of another corporation, our ownership is evidenced by shares. Okay, but it's also possible for you to earn other kind of uh, instruments that can give you additional voting rights or additional rights, ownership interest in the invested corporation. And in assessing whether you have significant influence or not, then you should take into account the uh, potential warrants or options that can give you additional interest in the entity that could uh, reach to the level of significant influence. Okay, the existence and effect of potential voting rights that are currently exercisable or convertible, including potential voting rights held by other entities, are considered when assessing whether an entity has significant influence. Okay, so if you are a holder of a potential voting rights, if you own a bond that can be converted into shares, then it's possible, if you exercise the conversion option, it's possible for you to have additional shares. And if you have additional shares, then it's possible that your ownership interest can go beyond 20%, thereby uh, resulting in a presumption that you have a significant influence. Okay, but what is interesting here, class, is that you will also have to take into account the potential voting rights held by other entities. Okay, what does that mean? Let's say, for example, you own 20%. Okay, and because you own 20%, there is already a presumption that you have significant influence. But some of the other entities, class, who own the remaining 80% are holders of potential voting rights, are holder of instruments that can be converted into shares. And if those instruments are exercised, it's possible that your 20% can be diluted. If they exercise their potential voting rights, your 20% may not be 20% anymore because they were able to increase their ownership interest over the associate. And in that case, then you may not be able to consider the investee as an associate. And in that case, you will not be able to apply PAS 28. You will have to revert to PFRS 9. Okay. So, uh, conversely, class, it's possible that you own less than 20%, but because you are a holder of potential voting rights, you are a holder of instruments that can be converted into additional voting rights, class, then it's possible you already have significant influence, and therefore you will have to apply PAS 28 in accounting for your investment. Okay. The last sentence for paragraph 7 tells you as to uh, when are potential voting rights not considered currently exercisable. Okay, paragraph 9, an entity loses significant influence over an investee when it loses the power to participate in the financial and operating policy decisions of the investee. So basically, this is simply an application of the definition for significant influence. Okay, and what is more important here is the second sentence, class, which tells us that the loss of significant influence can occur with or without a change in absolute or relative ownership levels. Okay, so even if your ownership interest remained at 20%, class, even though the others were not able to increase their ownership interest at your expense, it is still possible for you to lose your significant influence, because the measure here or the test here is not really the percentage of ownership as what we have discussed earlier. It would be your ability to participate in the financial and operating policy decisions of the investee. So, for example, you were able to conclude that you have a significant influence because you are represented in the board of directors, but later on you did not, you are no longer a member of the board of directors. Then in that case, you you may have lost your significant influence over the investee. So even if there is no change in your ownership interest, it's possible for you to lose your significant influence. So from applying PAS 28, you will have to revert to you will have to revert to PFRS 9. Okay. So under the equity method class, as mentioned, on initial recognition, the investment in associate or joint venture is recognized at cost, and the carrying amount is increased or decreased to recognize the investor's share of the profit or loss of the investee after the date of acquisition. We have discussed this already earlier. Okay. Additional thing to remember: aside from your share in profits and losses of the investee, there's another reason for your investment in associate account to go down or to reduce. Okay, we have here distributions received from an investee reduce the carrying amount of the investment. Okay, so what when we say that your investment in associate account class will go up and down, representing your share in the profit or loss of the investee, we are not talking about the amount that you may or may not receive from the investee. We are simply referring to the uh, our constructive share of the profits or losses of the investee. So in case the investee corporation, the associate declares dividends, of course, being part owners of the associate, we will also be receiving dividends. But if we are using the equity method, we do not treat the dividends that we receive as a dividend income. We treat it as a repayment of our investment. It's as if we are being forced to withdraw our investment. If we receive dividends from the investee, it's treated as a withdrawal of our investment, and that is why it will reduce the balance of our investment in associate account. Okay, so basically, investment in associate account increases with our share in profit and decreases with share in losses and share in the dividends declared by the investee, or it will decrease by the amount of dividends that we will receive. Okay. Another potential source for increase in investment is if we make additional investment. Okay. And that is very understandable. If you make additional investment, then definitely your investment in associate account should increase. Okay. Uh, the equity method class can be elaborated more when when you will be discussing problems in your intermediate accounting in your subsequent semesters class. Okay. But I want to direct your attention to paragraph 12 class. Okay. When potential voting rights or other derivatives containing potential voting rights exist, an entity's interest in an associate or a joint venture is determined solely on the basis of existing ownership and does not reflect the possible exercise or conversion of potential voting rights. Now, if you're reading this on your own, you might have gotten confused because we have just mentioned earlier that in testing whether or not we have significant influence, we have mentioned that we will already be considering the potential voting rights. But here is paragraph 12 telling us that the basis should only be solely for existing ownership interest and it should not reflect the possible exercise of potential voting rights. Okay? So is there a conflict here? The answer is no. The earlier mention of potential voting rights class is in determining whether or not you have significant influence. Here in paragraph 12, the mention of potential voting rights is in the determination or computation class of our share in the profit or loss of the investee. So what do I mean? Again, using our previous example, the investee reported a profit of 100,000. Currently, our ownership interest is 20%. So that means our share in the profit of the investee is 20%. In computing for our share in the profit class, we do not include the potential increases to our ownership interest. If you want to compute for your share in the profit, it should only be based on existing ownership because it would simply be ridiculous if you add your potential uh, voting rights to compute for your share in the profit, it would simply result in an overstated investment income. So if you're computing for your investment income, do not for your investment income or loss, do not include potential voting rights. If you are trying to determine whether or not you have significant influence, then of course consider potential voting rights. Okay, that is simply the explanation. There is no conflict here. The use or non-use of your potential voting rights are for different purposes. If you're trying to determine if you have significant influence, then use potential voting rights, not just yours, but even to the other shareholders. If you're trying to compute your share in the profit or loss, of course, it should be based only on your existing ownership interest. Okay. Your potential voting rights are simply that potential, expected. So your share in the profits should not include those that have not yet been converted or exercised as actual or real uh, shares. If you go over past 28 also, there will be a lot of mention for PFRS 9 because again, it's possible for you to go back and forth between PFRS 9 and past 28. Okay. But paragraph 14 is very clear that PFRS 9 does not apply to interests in associates and joint ventures that are accounted for using the equity method. Okay, again, it's past 28 that will apply. Unless an investment or a portion of an investment in associate or a joint venture is classified as held for sale in accordance with PFRS 5, the investment or any retained interest in the investment not classified as held for sale shall be classified as non-current asset. So very important takeaway if you will be asked how how are investment in associates presented in your statement of financial position? How are your investment in associates presented in your balance sheet? Then it should be classified as a non-current asset. Okay, and although I have not given you the discussion for PFRS 5 yet, even if you have non-current assets class, if they are held for sale in accordance with PFRS 5, they will now be classified as current assets simply because it will now fall under the definition for current assets. Okay, but as a rule for investment in associates, the classification is that it will be a non-current asset. Okay, paragraph 17 tells you of exemptions from the application of the equity method. Again, as a rule, past 28 tells us that investment in associates are to be measured using the equity method. Paragraph 17 tells you uh, of the exemptions. Okay, so this could be a good source for a multiple choice question. And you should be able to observe a common theme here. You can be excused from using the equity method as long as the stakeholders are well informed or that the use of equity method will only result in redundancy. Okay, so make sure to be familiar with the exemptions from the application of the equity method. Here you are also being introduced to PFRS 17, wherein an investment in associate is held by or is held indirectly through an entity that is venture capital organization or a mutual fund, unit trust, or other similar entities, including investment-linked insurance funds. Uh, this tells us that we may elect to use PFRS 9 and measure them at fair value through profit or loss because if your investment is coursed through this venture capital organization class, then definitely your interest is not on the ability to participate in the operations of the investee, but more on your ability to earn short-term gains from your investment. And in that case, especially if your purpose is speculative class, it will PFRS 9 that will be applicable. Now, if it is linked to insurance fund, then it will be PFRS 17 that will be applicable. Okay, so here, paragraph 20 class, what if the investment in associate is now held for sale? Okay, so an entity shall apply PFRS 5 to an investment or even just a portion of an investment in an associate or a joint venture that meets the criteria to be classified as held for sale. any retained portion of an investment in an associate or a joint venture that has not been classified as held for sale shall be accounted for using the equity method until disposal of the portion that is classified as held for sale takes place. After the disposal, an entity shall account for any retained interest in the associate or joint venture in accordance with PFRS 9 unless the retained interest continues to be an associate or a joint venture. So the scenario here, class, is that let's say, for example, you currently own 30%, and there's a rule that will raise a presumption that you have significant influence, and therefore it should be treated as an investment in associate. That being the case, you should be applying PAS 28 and therefore measure it at using the equity method. Now, later on, you decided to sell your investment in associate. Okay. Uh, and therefore, it will now be reclassified as a non-current asset uh, held for sale. If you will dispose of the entire 30%, then no problem. The entire 30% plus the entire 30% will be considered as a non-current asset held for sale. So the entire 30% will now be covered by PFRS 5. But what if your intention is only to sell uh, is your intention is only to sell 15%? Let's make it your intention is to sell it 20%. Okay, you own 30% and now you want to sell the 20%. What will happen to the 20%? The 20% will be reclassified as a non-current held for sale under PFRS 5. The issue now that is being addressed by paragraph 20 is how do you now measure the remaining 10%? Again, you own 30, you will be selling 20, you will be retaining 10. How will you now account for the 10%, the remaining 10%? Okay, paragraph 20 tells us that until the 20% is sold, you will continue to account for the remaining 10% under the equity method. Okay, you will continue to measure or account for the remaining 10% uh, under the equity method. However, after the 20% is actually sold, after the portion that was classified as held for sale is actually sold, the 10% now should no longer be measured under or accounted for using the equity method. Since the 10% now is very little, it no longer gives you significant influence. The 10% now should be measured under PFRS 9. Okay, so it should now be measured under the PFRS 9. Before the portion to be sold was actually sold, continue to account for the remaining 10% using the equity method. After the 20% is actually sold, it will now be, you will now have to revert to PFRS 9. Okay, you treat it as an investment that is covered by PFRS 9. Okay, second scenario being contemplated in paragraph 20, still we owned 30%, and this time we decided to sell only 10%. Okay, we only decided to sell 10%. What will happen to the 10%? The 10% will be reclassified as a non-current asset held for sale under PFRS 5, and the 20 now will remain as an investment in associate. So before the sale, the remaining 20% will be measured under the equity method. After the sale, the remaining 20% can still be measured using the equity method. That is if the 20% is enough to give us that the 20% is enough to give us significant influence. Okay, so you look at what happens to the portion that will remain. Okay, if the portion that will remain for the portion that will remain, class, it will be measured under the equity method regardless of the level of the remainder, as long as we are still before the sale actually took place. But after the portion to be sold is actually sold, it will now depend on whether or not you still have significant influence. If you still have significant influence, continue to use the equity method. But if after the sale, the remaining portion will no longer give you significant influence, then you will now have to apply PFRS 9. Okay, I hope that is clear. Now, here in paragraph 21, when an investment uh, was previously classified as held for sale no longer meets the criteria to be so classified, then uh, it will now have to be under past 28. So the result would be it shall be accounted for using the equity method retrospectively. So if it was reclassified, as held for sale 5 years ago, if it no longer qualifies as a non-current asset held for sale, it will go back to past 28. And in using the equity method, you measure it as if from 5 years ago it had always been an investment in associate under past 28. So what does that mean? You will have to make adjustments for your share in the profit or loss of the investee for the past 5 years. Okay, so you will have to treat it as if it had never been classified as an asset held for sale. Okay, but this can be demonstrated a lot clearer with a problem. But what's important is for you to be aware that the rule is to account for the asset using the equity method retrospectively. Okay, discontinuing the use of the equity method, this would be very similar to what we have discussed earlier when you have disposed of a portion and what will be the treatment for the remainder. Okay, paragraph 22 tells us an entity shall discontinue the use of the equity method from the date when its investment ceases to be an associate or a joint venture. That's understandable. Okay, this will happen if the investment becomes a subsidiary. Okay, so if your investment has increased to the point, your ownership interest has increased to the point that the investee becomes a subsidiary, then it will now be PFRS 3 and PFRS 10 that will be applicable. Okay, paragraph B is similar to what we have mentioned earlier. A possible takeaway here would be the treatment for the gain or loss. Okay, uh, because of the reclassification, it may result in a gain or loss. Uh, the previous carrying amount under the equity method may not be the fair value under the PFRS 9 because PFRS 9 dictates that on initial recognition, the investment should be measured at fair value. So you compare the carrying amount with the fair value of the retained interest, and the difference will be your profit or loss. Okay. So this tells us if for paragraph 23 is an elaboration on subparagraph C. If a gain or loss previously recognized in other comprehensive income by the investee would be reclassified to profit or loss on the disposal of the related assets or liabilities, the entity reclassifies the gain or loss from equity to profit or loss. So I hope you can still remember reclassification adjustment from uh, past one class, wherein an item of other comprehensive income can be transferred to your profit or loss for the current year. And as discussed in past one, that normally happens if the asset that gave rise to the other comprehensive income is disposed of. So the cumulative other comprehensive item of other comprehensive income will be reported as an item of profit or loss. So the same is true for your investment in associate class. Since you will also be sharing in the profit or loss of the investee, both profit or loss and other comprehensive income, if there is a portion that is disposed of, you will also have to reclassify the portion of the share of that portion class in the other comprehensive income attributable to the investee. I know this would be confusing, but simply the rule here is uh, any share in other comprehensive income will also be reclassified to profit or loss if the investment is sold or disposed to outside parties. But of course, if only a portion is sold, then only a portion of the other comprehensive income will be reclassified. If everything is sold, then the entire other comprehensive income will be reclassified to your profit or loss. That's basically the point in paragraph 23. In paragraph 24, simply for purposes of true or false questions class, if an investment in an associate becomes an investment in a joint venture, an investment in a joint venture becomes an investment in associate, you will just have to continue applying the equity method. Nothing trivial there. Okay, let me just charge my laptop first, class. Okay, continuing class. For changes in ownership interest, meaning your ownership interest goes up or goes down. If an entity's ownership interest in an associate or joint venture is reduced, but the investment continues to be classified as either an associate or joint venture, the entity shall reclassify to profit or loss the proportion of the gain or loss that had previously been recognized in other comprehensive income relating to that reduction. If that gain or loss would be required to be reclassified to profit or loss on the disposal of the related asset. So very similar to what I have mentioned in paragraph 23. Uh, for the actual application of equity method class, that would be best demonstrated through a problem class. So we'll just go over important rules here. That is required of you as far as our subject is concerned. Paragraph 33, the most recent available financial statements of the associate or joint venture are used by the entity in applying the equity method. When the end of the reporting period of the equity is different from that of the investee, the associate or joint venture, the associate or joint venture prepares for the use of the entity financial statements as of the same date as the financial statements of the entity. Okay, so the investee corporation, the associate or joint venture, will have to prepare uh, a separate set of financial statements wherein the information provided there will be aligned with the reporting period for of the uh, investor. Okay, so the investee will be the one to adjust. The entity's financial statements shall be prepared using uniform accounting policies for like transactions and events in uh, similar circumstances. So there's nothing tricky there. If an associate or joint venture has outstanding cumulative preference shares that are held by other parties other than the entity and are classified as equity, the entity computes its share of profit or loss after adjusting for the dividends and such shares whether or not the dividends have been declared. This is noteworthy, class, because if you have preference shares, cumulative preference shares, you will have to pay for their dividends as if they are loans, class. So even if they are somewhat equity instruments, but by their very nature, they are more of a debt obligation, class. So, in computing for your share in the profit or loss, you will have to deduct the dividends that would be payable to the uh, shareholders of your cumulative preference shares, because whether you like it or not, you will have to pay the fixed dividend payable to these shares, class. That's a unique feature of your cumulative preference shares. For preference shares, class, their dividends is fixed. Unlike your ordinary shares, it would depend upon the amount of dividend that will be declared. But for your preference shares, it's fixed. Normally, it's a percentage to the par value of the preference shares. And the problem with cumulative preference shares, class, is that even if you did not declare on this year, and you declare dividends next year, you will have to pay the fixed dividend for this year and the previous year. That's what we mean by cumulative. You have to pay for all the past periods. So, in some sense, really, your cumulative preference shares partake the nature of a debt or obligation, wherein the dividends are in reality interest payments. Okay, so this is just a tiny tidbit information that may be asked on how you're going to compute for your share in the profit or loss of the investee. Okay, so that would be all for past 28 class. I hope that